All right, awesome. So we are live. So it's Lawrence Raponi, and you said with Lawrence, not Larry, it's Lawrence Raponi. It sounded like when you said that there was some like grade school stuff that kind of happened that the Larry Raponi doesn't go well together or something.
Larry Raponi sounds awkward, but truthfully, only my mother calls me Lawrence.
Oh, really?
Work, all my clients, Larry.
Oh, perfect. So we're going to call you Lawrence then. This is great. This is great. And Cosme Reveredo.
Reveredo, you nailed it.
Which I just learned is Portuguese influenced Indian name.
Yeah. So my family's from a coastal state, Goa, just on the south of India, we'll say. But it used to be a Portuguese colony just over, I want to say about 50 years ago now. It used to be a Portuguese colony. Yeah, so the name is Portuguese influenced and inspired. My first name actually comes from Cosma, which is, I guess, popular in Portugal. I don't actually know, but so it's a bit of a spin-off of that name.
I didn't know there was any Portuguese, like any areas that had like a Portuguese influence.
Portugal colonized quite a bit of, part of the world, actually, right? Way back when. But I mean, there's influences all around into Africa as well. Kenya and Tanzania, you'll find Goans there as well. So
wow,
yeah, it's an interesting little mix. I wish I did more research into my own history, I guess, but yeah, there's a bit of a Portuguese influence.
I think as we get older, we all kind of do. It's interesting to look back
we gravitate
and see what
that
the
way.
hell, to see what's going on. I know, we come from, we're born here, but our parents come from both interesting parts of the world because our mom's Scottish, and if you look at like all the just kind of fighting and stuff that happened over in that area of the world, and then our dad's Croatian, and then if you look at all the just the mix and the mesh of people that are in that world fighting, it's just been, it's two interesting parts of the world. Yeah. It's so weird when we go back to like, talking about India or Europe or those places and even our kids now, they're like, I don't get it. So they come back to Canada and they're like, we just don't have, it's not that we don't have history. It's just the length of time here. There's just the history that we know of from being
that history
evaporates
so quickly.
Yeah.
Right?
Well, we're all sons of immigrants. I'm assuming it's all how we got here, unless you're native. And so
Raponi's, that's got to be Italian.
We're Italian,
yeah.
Exactly. And I'm first generation Italian. I don't know if you guys are first or second, but it is what it is. Our history started when our mothers and fathers got off the boat. Right?
Yeah.
That's what I remember. But the older we get, and this is hitting home with me now because I'm expecting my first kid in about 5 weeks, you start to think more about where you came from, right? The older you get, the more you sort of look backwards and the broader your perspective becomes, right?
You know what's interesting to me, like what you said, our parents came here and they had no network. They didn't have much. So when we were growing up, my parents had some friends, but then there wasn't this kind of like network of people locally that they really knew. And then, we built that because we had our friends. So our friends, were a bigger base and, knew more and more people. And then through business and what we do, we've met more and more people like you guys and everything. And I'm just looking back and I'm like, oh, it's very interesting because as time's gone on, there's always like, my kids now are like, well, what about this? I'm like, well, we know this guy for this, or we know this person for this. There's always like this person in so many different industries. And it's a real leg up because when you have your roots someplace, it makes such a difference, not even just about the amount of time you've been here and the money, but just your network of people that you can reach out to, that your kids, so you're going to have a kid soon. So when's that?
Son, I'm having a baby boy and he's coming Christmas Eve, the 24th of December.
I'm not going to say congratulations yet. I'll make sure everything goes good.
The next podcast.
Yeah,
we'll have another conversation.
That's cool. But that's funny. So when he grows up, through you, his network around here is going to be so vastly different than even when you grew up.
Exactly. But even back then, so when my parents came here, they might have been, 16, 17. So did education in Italy, didn't speak any English until they came here. But all my paesani, all my family friends are the guys.
Yeah.
That's what we call them,
yeah,
right?
Sure.
It's unofficial family.
Hey, paisan.
They're the people that came over on the boat with us from the same small town that my grandfather was from. And that's actually how we got started in real estate. So my grandfather started buying real estate the second he got off the boat, essentially. He started a bricklaying business and started buying plots of land. And he would go in on properties with the paesani, the people he came here with off the boats, because they didn't have enough money individually to go and buy a house, even back then at the lower prices.
So why did they buy real estate? Like, why was he so interested in buying real estate when he came here so early?
I think it's hard to say for certain. He's passed on decades ago, but I think, and this is the reason why I like real estate and maybe so many other Canadians, it's a simple asset class, right? You look at something like the stock market and you're investing in something that frankly, we know very little about. We have very little control over it, what's moving the market. You're just kind of riding in a current on someone else's ship. Real estate's simple, right? You can value it. You can see where your cash flows are coming from rent. You know what your expenditures are going to be, whether it's taxes, utility bills, it doesn't matter. So for a new immigrant like my grandfather, it was easy to piece it together, right? Mm-hmm. Now you couple that with the fact that you can live in it and raise a family, it's a no-brainer, right? Mm-hmm. And that's why I think so many people gravitate towards that asset class.
And same thing, you feel the same way, Cosme?
Honestly, to be honest, my family was largely, and I think this is traditional with most Indian families, as far as storing wealth, they turn to gold.
I've always respected the Indian culture for that. Yeah. I'm like, these guys get it.
Yeah,
especially the women when they come here in Canada, they're like, don't worry, these 50 gold bracelets that I have on my arm, that's just jewelry. That's not me taking money across the border. That's nothing at all. I'm not saying anything, but I figured you guys out. Right?
Yeah, no, because my family and my father traditional, just pay everything in cash, everything hold in cash or just hold it in gold, and they would never really thought about real estate. I didn't even get exposed to real estate until university. I think it's the same with you as well. Mm-hmm. When you made your first first real estate purchase. So for me, it wasn't even until university when I decided, the real estate, there's something here. There's a way to sort of build some kind of generational wealth through real estate, especially here in Canada. And that's sort of when my mindset, I guess, shifted personally. So
yeah, it's interesting to see because I feel like you don't take things from cultures with longer history than we have here. They've seen the benefit of things like gold, mm-hmm. of things like real estate, because, the Italians are into gold in a big way as well, right? They've always gotten that as well, because you see it. But when our history is shorter, you haven't gone through these cycles, these monetary cycles where you kind of get what we've seen over the last few years. You get debased and you kind of get really, wiped out from an inflationary standpoint if you have savings or you don't have these hard assets. And that's why I feel like a lot of immigrants from these countries with longer histories, when they can look at their grandfather or great grandfather or past generations and they tell them like, hey, here's the lessons we've learned because in this country, here's what's happened with money in the past. And it just kind of makes a difference, right? Mm-hmm. What are you guys seeing right now? So at Equiton, what's the latest? Like you guys have your apartment REITs, you have some developments. So let's start with the apartment side of stuff. What's going on there?
Maybe we'll take a step back. I'm an AVP at Equiton. Cosme is a senior associate at Equiton. For the listeners that don't know, Equiton's a passive real estate investment firm, right? We're giving investors exposure to physical real estate assets, but without many of the hurdles that typically exist with real estate investing in the GTA. It's really that massive down payment that's required, the need for financing, which is a hot topic today, and then of course being a landlord yourself. But
just accredited investors or no?
No, we can accept investors from anyone as long as they're over the age of 18. Okay. Honestly, so it's a pretty broad swath of clients we have. We'd like to think we democratize the world of real estate investing in some small way. I look at the market today. Things are changing, right? Things have been changing from that period of time, maybe a decade ago with 0% or bare bottom interest rates. I'm seeing a market today characterized by three forces. First is immigration. We're seeing a massive influx of new Canadians, international students, primary residents, whatever the case may be. And that's, of course, putting constraints on the demand for housing, right? It's increasing the demand for housing. Second thing we're seeing is interest rates are high, and everyone knows that. It's a no-brainer. That's increasing the carrying costs for housing. And thirdly, it's the structural impediments to onboarding new housing supply, right? As a developer, which Equiton is, it's really hard to bring new housing supply to market, right? It's very inefficient, it's time consuming, and it's expensive. Those three market forces together are impacting the market in some pretty weird ways, right? And so maybe we'll flush out those ideas over the next hour.
Here's something I want to ask you. So I've always looked at things. We've been following this immigration story before it was a hot topic. So I forget the first time I looked back. I think it was I want to say 2016, but I'll say 2018 was the first time we started running some rough numbers. Actually, now that I'm thinking the chart that I'm looking at, it might be 2016. And we're like, something's not adding up here. And we started looking at immigration numbers and we looked at past supply, and the numbers were really rough with what we could find at that time. And that's when we started looking at this immigration number and we're like, wow, something's out of whack here. But now that everyone's talking about it, so we're contrary people. I'm always looking like if the masses are going one way, I'm like, why the hell is everyone going that way? I need to be going the other way. Like, should I be going the other way? So I'm looking around. And now that everyone's talking about this immigration number, I look around and I have to question my own belief because I believe it. Like I know the numbers and I know it's true. And I'm just like, what am I missing about this? Like, can the bottom fall out of this pretty quick? And I guess the only thing I see, I know they just came out with their next forecast. So it was 500,000 pretty much moving forward is what they're looking for. And then there's non-permanent residents have really thrown things out of whack. Mm-hmm. And I'm just like, so maybe they pull back those non-permanent resident numbers, but then that's still that 500,000 permanent resident number is really big.
It's really, really big. Well, let's dissect that a bit. So last year, 2022, the target for immigration, net new entrants into the country was 500,000. They came through with 1 million. It was an all-time record high influx of populace into our country. That excludes what I would call, I guess, I don't know what I would call them, but non-permanent residents. So things are things like international students, right? Very, very hard to use that as a barometer and judge how much international students are coming through.
It's temporary work permits and student visas are typically the majority that make up the non-permanent resident number.
Exactly. And that's hard to track. So last year was 1 million and it was what it was. This year we're saying 500,000, 2024 and 2025, again, 500,000. So between now and 2025, we're expecting approximately 1.5 million net new migrants to the country. I'm not convinced that the government is going to put a cap on that anytime soon. We need these net new entrants because if you're a politician, you're looking at this as a way to boost and bolster economic growth.
Yeah, that's how they're trying to grow.
Our GDP is not growing on a per capita basis anywhere near the level of our neighbors to the south, right? Our economic growth is driven primarily by population growth. And that's a dangerous position to be in because we're reliant on these net immigrants, right? We need them, right? They're going to make life better for everyone. And of course, it poses other problems as well, right? Supply for housing is the big one.
Well, yeah. Well, roads, hospitals,
infrastructure,
like anything,
education, and any provincially regulated infrastructure, healthcare, education.
So the thing that's blown our mind before is when you look at it, the immigration number, regardless of what their target is, and they, unless changes are made, our immigration policies are really being dictated by the post-secondary institutions, because once they have, and it's not guaranteed that they have to get in once they have an acceptance to one of these institutions, but the odds of you getting a student visa once you have an acceptance go up dramatically. Because I said in the past on a podcast that like, hey, basically once you get the thing, it's like you get the student visa.
It's almost.
And someone's corrected me. Well, it's not guaranteed. I'm like, okay. So if you're listening there, I'm not saying it's guaranteed, okay? But the odds are like, I don't know the percentage, but it's like 95+%. And then that's why we get all these random schools opening up, and even the big schools that were established. Now they're opening up like 15 other campuses in all these small areas, and like they rent out a unit in a strip mall.
For
and
sure.
All of a sudden, but they're driving our immigration numbers. So we have the federal government not talking to the provincial municipal governments. We have people in the private sector that are incentivized to get people here because if you look at the revenues from these schools, the vast majority of the revenue of these schools are being driven from international students. Yeah. So they're just pumping more people in. So like no one's talking to each other. So we have this huge population boom and we've had no infrastructure, to your point, housing, and it's just screwing up the dynamics everywhere.
Yeah, even with international students, I mean, there's recruitment campaigns across the globe rather, to bring in these international students that, whether or not anyone or anyone here wants to sort of admit to it, there's quite a few of these recruitment programs going on that I know personally.
Oh yeah.
That just to target.
Well, you're from India. If you have people in India that
I didn't want to say, but
yeah. Oh yeah. No, Keith, someone on our team here, our marketing manager, Keith, he gives us the inside scoop on exactly what's going on in India all the time. It's like, guys, you have no idea how big this industry is there.
Absolutely.
Right?
Mm-hmm.
Yeah. So, okay, so then with that, so let's circle back to then what are you guys seeing? So with this now, with that population boom, specifically students, is that even an area you guys are looking in, some student housing stuff, or are you guys, that's like, no, you're just looking at the bigger picture?
Cause?
Yeah, largely residential is our focus, right? I mean, our apartment fund is largely residential focused, and we just picked up another building actually just 2 weeks ago, I think, acquired officially in London. So it's our third property in London, I believe.
Third property.
Where's the fund primarily Focused, yeah.
Yeah, largely focused in Ontario. We do have 2 buildings out in Edmonton as well.
Okay.
That we picked up last year. I mean,
primary for now, at least primarily Ontario.
Yeah, I mean, our home base was Burlington, right? I mean, so if you go around the peripheral areas around Burlington, that's really where our resources were, right? And still are. So, it only makes sense from like an economies of scale perspective just to pick up more properties within this area. But we love Ontario, of course. But yeah, we did move into Edmonton last year, and maybe there was more to come in Edmonton as well. But as far as mandate, we're Canada-wide. So wherever the resources are, we'll sort of have a look at it. And it's all a business at the end of the day. You understand, like, multifamily is a business, right? So wherever it makes sense, really, just from our internal thesis perspective, I guess. Right?
Well, so what's better? Is Alberta or Ontario better?
Loaded question.
Yeah, no, I'm joking. The reason I was asking,
how many people can we?
I'll take a quick stab at that. So,
first of all, just so you know, I'm joking because we had some people in here from Alberta, and we kind of, I guess we got into that a little bit. This was a while ago. This was earlier this year, and one of the clips that we took, and where did it go? I guess it was on Instagram somewhere. It got like almost 2 million views after, and we realized, we're like, oh my God, when you make people dislike each other on the internet, Alberta versus Ontario, and people start like just fighting about it, because all these comments were like, oh, we're better because of this. We have Connor McDavid, we have Austin Matthews, we did these random things, and it just like the algorithms pick it up and it goes crazy. But yeah, I'm not knocking anyone from Alberta. I was just joking. But go ahead. Yeah, I'm curious. What do you see in the different dynamics?
So I can't speak for every single residential real estate investor. There's many different tools that investors have in their toolbox to achieve whatever goal they have, whether they're buying pre-construction, they're flipping houses, they're doing a long-term buy and hold, which is our bread and butter. But because we're long-term buy and hold, and because our residential fund pays very high, very stable cash flows, that's a top priority for us. Now, we like Edmonton, frankly, because of the cap rates that it offers and how well insulated it is from changes in the employment landscape out there. A lot of people love Calgary. They're flocking to Calgary. Everyone's heard about the growth story out there. The fact is, their job market is actually more reliant on the energy sector. That's concentrated in certain areas in a way that doesn't make us all that comfortable. So we're getting a much higher cap rate, which leads to better cash flow positivity out of Edmonton. We're seeing an employment market out there that's more diversified. So they still have that commodity exposure, but they have a massive public sector, right? And they have an emerging tech scene as well. So
does Edmonton have a big public sector? I didn't know that.
They do. A lot of government
really?
workers there. And again, very strong, stable jobs, great pensions. And so these are people that are going to continue to pay rent over time.
Huh.
Right?
And you guys say you were saying you pay out a high cash flow. Yeah, so what do you guys aim for? Like, what is the typical payout there on that fund?
We're currently paying an annualized yield of 5.84%. Okay. And that's doled out in monthly distributions, right? So just like you're going to buy a triplex and receive monthly rental income, our residential fund is going to pay our investors the exact same way on the 15th of every month, like clockwork. And just like your rental revenue is going to increase across time, our distributions continue to climb higher and higher over time as well.
The monthly's nicely. Nice. Do a lot of, do other people that do this type of thing usually pay out monthly? Is it quarterly or yearly, or is it monthly? Is monthly common?
I think it's fairly common, right? I mean, in the private space, at least, even in the public market, I guess, even public REITs, I mean, there are some that do pay out monthly, but private space, I think is fairly common. But again, I think there are some that pay out quarterly, but, everyone likes to see that cash flow come in on the 15th of every month, which is the case for our investors, at least. It's just a nice feeling when you know something's coming on the 15th of every month, right?
Can you choose to reinvest that? Is that an option or else?
Absolutely. So you can either take it in cash or you can reinvest it as part of our reinvestment program, and you're sort of incentivized to reinvest it as well, because you can purchase in new units at a bit of a discount, so to the unit price. So.
Yeah, and then you're taking advantage of the benefits of compounding, which I'm always astounded when I talk to clients how little they understand compounding. I feel like the human brain just can't process the effects of compounding. Einstein called it the ninth wonder of the world, or whatever the case may be.
You got to see, right? You have to, once you see it visually, you're like, holy crap.
Yeah, it starts to make a whole ton of sense. And most of our clients, they're investing with their registered accounts, right? They're using TFSAs, that lira from some old employer that you left 7 years ago, or an RRSP, right? So in those instances, you can't take the cash flow anyway.
Oh my God,
a lot of those clients, they're just reinvesting it, right?
I have a lira, I think.
Everyone's pretty sure they have a lira somewhere at some life insurance company.
No, because I used to work at the region of Peel. Yeah. And when I worked at the government, and you know what I did? I parked it. This is now oh my God, when did I leave there? 20 something years ago. Yeah. And I'm like, you know what I'm going to do? I'm just going to park it in these like emerging market funds or something. So I'm like, it's like emerging markets. That's like high risk, right? But it's high growth. So I'm like, okay, no problem. Like, I don't care about ups and downs because I can't take like to your point, I can't take this money. My understanding is almost like ever, right? And
so you're 65?
Yeah. So I'm like, oh, let's just leave it there.
Well, that's usually what you find with the case with anyone that we speak to that have registered funds, Lira especially. They sort of have it parked somewhere. They don't really have ownership over it that they know of, and they're not even really actively managing it. So they sort of forget about it. But then they realize, wait, we have something here that we can at least utilize or leverage to invest in something that we either understand or we like.
Yeah.
Why not, right? So
that's what last year I find is when 1 or 2 years ago is when I finally looked at it and I'm like, oh, I should do something with this. And because after 20 years of these funds, I had the same amount of money. I'm like, how the hell, with the price of everything going up, how the heck can I have the same amount of money in here? And yes, I took it, but I forget what's in there. I should talk to you guys about it.
And everyone does. And Liras are notorious for that, right? They're in some high fee mutual funds. You're not really certain what it is. They don't really go anywhere. And I don't know why, out of all the registered accounts, the TFSAs, RRSPs, Liras, the Lira is the biggest culprit of wealth destruction. Not because it drops in value, but just because it just doesn't even appreciate with the broader market.
Yeah, it's so funny.
Yeah, and people don't seem to care about it because they just forget about it. It's out of sight, out of mind, right?
So when you guys go to buy another, in the fund, when you go to buy another property, how does this thing work? Because then you guys are raising additional capital. Because if the fund, is there always just extra money flowing around in the fund? Like, how does this thing work as an investor? Yeah. So if I'm trying to understand it.
We'll unpack it a bit. So first of all, Equiton operates 2 funds. And then Equiton isn't the owner of the funds. We don't own the properties. We're asset managers. Okay. Our job is to add value through active portfolio management to maximize the value of the buildings and the amount of cash flows they generate. That's our mandate. Our investors own the buildings that are in the funds because they own the funds. So we're looking to acquire more and more assets as we take in more capital. Well, I'm incumbent on you, Mr. Investor, to give you a return. I got to give you that 5.84, right? So I'm not going to hold your money in cash. I need to put it to work. So as we accumulate more capital, we go out and buy more buildings, right? We buy more properties and we put them under our management. And that's how we've been able to grow the fund the way we have.
Got it. Okay. And you said 2 funds. What are the 2 funds?
So we have a long-term buy and hold fund on residential real estate. We call it the apartment fund for short. And it's the exact same thing as any single investor going out and buying a residential property, managing it themselves, taking in rental income, participating in some appreciation. That's exactly what it does. We own and operate apartment buildings. And again, we maximize not only the value of the building, but also we maximize cash flow. That's our mandate. And we do that through active management. So it's a value add strategy.
Okay. And before you touch on the other one, so then how do you get the appreciation? Because in theory, if the building if the portfolio appreciates by, call it 10%. So when someone's able to exit the fund, how easily is it to exit the fund? Is there like a waiting period, or is it locked up for a certain period? And then I guess do they get the value of that building at that time? Like if they've been invested for a few years and in theory the value went up?
Mm-hmm. Cos, you want to take that one?
Yeah, so in terms of valuation, we get all of our buildings externally appraised on a quarterly basis, right? So CBRE is our external appraiser. They come in, they provide a valuation on every one of the buildings. So at any given time, when we mark our net asset value, and we do this on the first of the month, our unit price is a true reflection of the actual valuation of our portfolio, we'll say, right? So whenever the investors entered versus whenever they exit, they are getting the true market valuation of the actual properties within the fund. So that's how we sort of, keep our valuation in line in terms of how we price our unit price. So our unit price will increase or decrease, and that'll be driven by the appraisal reports that we receive.
Exactly.
I'm sorry, I was not.
When an investor buys in, they're buying in at the market price for the portfolio of assets, and that's reflected in the unit price, which you can think of as a stock price, right? Might be $15.75, might be $24.82. When they sell that investment, they're really selling it back to us because we're a private equity firm, right? There's no secondary stock exchange or market to buy and sell these. So they're really knocking on our door and saying, Equiton, it's been fun, but I'm buying a cottage. I want you to buy my units back for me. And we will at their request. And we're going to pay them the market price as of that day. And that's how it works.
And how is there a waiting period if you want to sell, or can you sell, if I want out, I can usually sell back to you guys within a few days or something?
Well,
how's that work?
Here's the rub, and it all comes down to the fact that we're not a stock, right? There's no secondary market to buy these things. And it also comes down to the fact that we're long-term investors, right? I'm not day trading buildings.
Yeah, you don't want people coming in and out of this type of thing every week, right? Yeah, for sure.
When I buy a $50 million property, I'm buying it under the pretense that I'm never going to sell it, or at least for a decade. So we have minimum holding periods on the investments, right? So for our residential fund and income and development fund, we're looking for a 5-year commitment, right? Because we need the timeline for our clients from a time horizon perspective to be aligned with the strategy we're employing, right? And like I said, we're long-term buyers and holders. That said, our investors can redeem their investments at any time. So in our industry, we call it a soft holding period. And that's just jargon for the following. If you want to redeem before 5 years, you can. However, if you redeem before that 5-year period, we're going to be charging you early redemption fees. Now,
that's fair.
It's not the way we make money, but we use the fee structure to incentivize the 5-year commitment.
That's normal. And this type of thing, intuitively, this is normal. Sense, like, it's just the people, if people haven't invested in this type of thing before and they're used to the publicly traded REIT or something like that, they might be like, oh, that's weird. Why are you guys doing that? But in this type of thing, that's normal. That,
even intuitively, right? You think about it, it's real estate. In order to have real estate and extract value out of real estate, it takes time to put that money to work, for one, and then it takes time to extract the value out of it, right? So, and part of our discovery process, whenever we speak to any new prospect or client, and they have an understanding that it's going to be a longer term hold. We are a longer term fund, and the benefits of being a long term investor, of course, right? So,
what's the other fund you guys do?
So the second fund we have is called the Income and Development Fund, and it's more of a jack of all trades fund. It's got a bunch of different asset classes in it, all within the real estate industry.
But that's not the development projects that you do on a case by case.
Those are something else entirely. So the Income and Development Fund is broken into 2 halves. You can think of a pie chart. It's split right down the middle. Part of the fund's invested in very consistent, very stable income-producing investments, and it pays a monthly cash flow coming from those income assets. The other part of the fund is invested in longer-term, higher growth development projects, right? So as I said, it's a jack of all trades investment. You're getting exposure to those long-term high growth developments, but while you're waiting for them to come to completion, you have your monthly cash flow being paid to you on the 15th of every month, like clockwork.
So you look for, in that case, there's more potential upside.
You're right. It's got a higher targeted annual return than the residential fund. The residential fund is on the lower risk spectrum of investments. It's very consistent. It's very conservative. It's very stable. The Income and Development Fund has a higher return profile, but it's extracted over a longer period, right? Because you need time in the fund for those development projects to turn over, right? If you're going to stay in it for 6 months, it's a terrible idea, right? Because we may not pay a development out in the next 6 months or 7 months or even a year, right? So it lends itself to a longer term strategy.
I got it. So what are you guys seeing just in the space right now? It totally, like, are investors a little bit gun shy right now at real estate? Are the people just kind of wanting to stay a little bit more liquid? Because a lot of the investors we speak to right now, they're just like, you know what? I was talking to a guy the other day, for example, and he was looking at picking up another property, but he's like, you know what? I'm just going to hold off just for now. I'm going to wait till the spring. I just kind of want to stay liquid, right? I just want to kind of almost see where the dust settles. He's like, I feel like we're kind of through the worst of, we have an idea where things are going to be, but he wants to see where the dust settles. So he's just kind of got his hands in his pocket. Are you guys seeing the same type of thing from your typical investor flow to you guys? Or is there, something else that you guys are seeing?
Yeah, there's definitely some hesitancy and some fear, right? I mean, at some point, people do want to see where we settle in terms of interest rates, right? I mean, I think at this time next year, we'll be at a place where, we're in a more normalized environment, we'll say, right? I don't know what the rates are going to be in next year. We don't have a crystal ball, of course, but I think there is some of that, hesitancy to pull the trigger. But again, as Lawrence mentioned earlier, a lot of our investors are coming through by way of registered plans as well. So they understand that there's a longer term commitment involved in registered plans anyway. So they understand that, at some point, if real estate and if and when it normalizes, it won't have as big of an impact on them if they come in today versus if they come in 6 months from now. Right? So
that's the challenge I think sometimes we face when we're talking to investors, because they come to us sometimes, so new people, right? And they're looking at real estate as like an asset that you trade. And they're just like, well, the market's here and it's here. I'm like, okay, yeah, you're right. Like, I don't know where it's going to, maybe it's up a little bit next year, maybe it's down. Like, I don't know. But Tom and I have always talked about every property we own. We similar to exactly what you were just sharing, we're like, it's 5 years. Like 5 years, are we happy to own this for 5 years? And then after that, are we actually happy to own it longer? Mm-hmm. Because who knows where 5 years from now, but that's kind of like the horizon that we start with. And it's always surprising to me how many people look at real estate as like they're trying to always time the market and I'm like, guys, you're not like, and maybe some people do, but you're not trading this stuff because it's, first of all, pain in the ass, and the fees involved to get in and out of a property, they're high. So you can't trade this stuff on a regular basis, but it's the way people look at real estate generally.
Yeah. It's the way people look at everything. I mean, we live in a world driven by social media, right? Everyone wants information now. They want everything they want now. And real estate just doesn't lend well to that. Mm-hmm. They're not the same thing. Especially over the last few years, because we had these like unreasonable appreciation numbers. For sure. So we're seeing a number of people now that they've come to us and they're like, hey, like I'm in a jam. I got these closings coming up in 4 or 6 months. Some condos they bought. They're like, oh, why? Where are these? Why'd you buy them? I don't know. I just felt like I didn't have enough. So they walked into the sales office and bought like 3 units because there was some low down payment structure and they didn't have to worry about it for a certain number of years. And now they're like, I don't even know if I can close on these things. Yep. So at that period of time, people were literally just throwing darts and just like buying stuff. Exactly.
Right? And more or less speculating, right?
Yeah.
100%. That's the difference. I'm glad you said
they're not investing, they're speculating.
Yeah. There's a real difference there, right? Absolutely. Mm-hmm. Sorry, what were we going to say?
Well, that worked for a long time. Yeah. There was a 5, 6, 7 year period where you could literally go blindfolded and throw a dart at the board and make 20%. The problem is, like you said, now you're closing on these properties and then the tide's out and we can see who's not wearing any bathing suits, right? It's the way of the world. One thing I will say, because people are very tepid on real estate right now, right? Interest rates are high. And what I see is I see this sort of disconnect between prices that sellers are willing to accept and what buyers are willing to pay. Mm-hmm. And eventually, I'm of the belief that eventually it's the sellers that are going to have to give in and eventually we'll see a little bit of price deterioration in the future. But that's more in the retail single family home market. In the institutional real estate side, which is the side that we play in, it's the pool we play in, it's actually a very good time for us right now. And so Equiton is a firm that's going shopping right now. And I'll explain. We're competing with other institutional buyers for a $50 million apartment building, right? We're not competing with Joe Schmo from down the street. So when you're a publicly traded REIT, whether you're Cap REIT or RioCan, whatever the case may be, you raise money by issuing stock, right? That's what you do. You go in the stock market and you issue stock. You want to issue that stock to raise money to buy new buildings when your stock price is at its highest, right? Because if I need $100 million, I don't want to dilute my company. So I want to issue as few shares as possible at that high valuation. 2022, publicly traded REITs fell 17%. 2023, they fell another 6 to 8, depending on which REIT you're looking at. Their prices are depressed. The last thing our competition today wants to do is issue stock at these lower valuations to go out and buy more properties, which means we have a competitive advantage because, again, we're private. We're completely agnostic to that type of market risk, right? So our unit prices are very stable and we're able to raise capital and deploy it more efficiently than a lot of our competitors today, which is something nice.
But what's the reason that they don't want to issue more stock at the depressed prices? Because they could still raise the capital.
Because it's dilutive, right? Like if you have a stock price of $100 and I have a stock price of $50, you need $100 million to buy a property and I need $100 million to buy a property. Well, at $100, you're going to issue 1 million shares to get the 100 million. So now you've diluted your equity by 100 or by 1 million shares. Oh, yeah. I'm at $50 a share, so I need to issue 2 million shares of ownership. I'm diluting at a lower valuation, much, much more than you are.
I never thought about like that from the REIT side of things.
Now, they can take on debt instead of issuing equity, but then again, they're paying sky-high interest rates, right? So publicly traded REITs are getting fleeced right now because they have an inability to raise capital efficiently. And for a private equity firm like Equiton, it's a huge competitive advantage for us.
Huh. How does that impact the investors that are in there right now? Because then they have the same number of shares, but they get diluted. So when they sell, it just forces the price down that way.
And that's what we're seeing with the public markets, right? And we're seeing a whole host of other market risk they're taking on, right? Things are going up and down with just the currents of the market, right? Janet Yellen's going to come out and say something about treasury issuances, and then the market's going to get scared and the whole market's going to sell off the S&P 500 and your publicly traded REITs right along with it for no rhyme or reason, right? And private firms like Equiton don't operate that way because there's only one thing that impacts the value of our fund. It's those quarterly appraisals that Cos was talking about 10 minutes ago.
So right? for the fund, you guys are looking at apartments and multis, but then are you also looking at, on the development side of things, are you guys looking at land and that type of thing as well?
We do, but we have standalone projects that we do development investments with and the income and development fund. But Cos, maybe I'll let you speak a little bit more about that.
But hold on, just on the land. So are you looking, so I understand you have individual projects, but you guys do have, like right now, are you looking at land?
We're not land banking. So anytime we acquire a parcel, it's for a particular development that we've already executed due diligence on and have a vision for. So we're not buying cornfields and hoping that the Doug Ford government's going to somehow envelop that into the urban zoning.
So
that's not what we're doing.
From the bit that you've seen with development, has the land value, where have the land values gone over the last couple of years?
Cos?
I don't even know if I can answer that.
Yeah, I mean, I think they've held quite stable, but mostly because, again, there's that discrepancy between buyer and seller prices. So a guy might be sitting on a car dealership that he's owned for 25 years, and he's just not going to sell it, right? Because he's just going to wait until interest rates go back down to 2.5%, if they ever do, and he's going to try and sell it for 15 or 20% more. The mortgage was paid off 7 years ago. He probably inherited it from his grandfather. He doesn't care. Right?
Yeah. Okay. I got you.
So, and as buyers on the buy side, we're being a lot more particular, right? A lot of developers now, given the interest rate climate, are looking for things like VTBs or much longer closing periods to do more thorough due diligence. Whereas 3 years ago, you would pretty much waive all conditions and throw an offer on a property, right? We saw that on the individual household side, but we saw it on the institutional side too. Equiton never really conducted ourselves that way because that's a surefire way to get burned. But we saw a lot of developers do that, right? Shoot first, ask questions later, we'll make it work.
Are you guys, so for those individual projects that you're looking at, are they more geared towards high rise or low rise?
No, we typically stick with the mid-rise formula.
Okay.
And like our formula is fairly consistent across the board. So we like to pick up a project on a busy street or major street, close proximity to the highways, close proximity to public transit, close proximity to the lake if we can. So it's around that GTA corridor really. And just mid-rise condo, that's sort of our comfort zone. Between we'll say 4 and 6 years in terms of duration to completion. I think that's fair to say.
What's proximity to the highway? What like to the public transit and highway? When you say proximity, how close is that? Is that 500 meters? Is it 1K? Like what do you? Yeah, ideally, I mean, I know it varies, but
within a couple of kilometers to the.
Yeah, for sure. Yeah, every project's a bit different, right? So maybe you're closer to an urban center, so you're closer to downtown Toronto. Well, my need to be close to a highway is now lessened because there's other transit infrastructure available, whether it's streetcars, subways, buses. So we don't necessarily need proximity to a highway in isolation. It's more proximity to transit infrastructure, period. We're looking at overall accessibility from a holistic level, we'll say. But we're considering other things as well. And to Cos's point about why we do mid-rise, there's a few reasons. Number one, we're not a multi-trillion-dollar development firm, right? We're not Menkes, we're not Minto, we're not Tridel. And the second reason is because a lot of other developers do what we do, right? They offer standalone development projects. And as these companies grow, the scale of their projects grow. And when the scale of a development grows, the time to completion grows, right? You're not doing a uniphase low-rise development. Now it's a 4-phased 15-year project. It's a master plan community, whatever the case may be. And that's actually left a hole in the market for these shorter developments. A lot of folks I speak to, they're maybe in their late 50s, maybe broaching early 60s. They don't want to lock up 50, 100K in a 7-10-year project anymore. Yeah. It doesn't make them comfortable, right? But a 3.5 to 5-year project, much more amenable to.
Yeah,
right?
Yeah, that makes sense. I mean, you see it for sure. I know the uptake on some longer, more. That's
okay.
Longer term projects.
Yeah.
Some people will pause at that for sure.
For sure, and it's not that the longer projects are bad. Don't get me wrong. It's just that different investments are good for different.
100%.
Right? If you're a younger guy and you're investing with that lira that you got from some previous employer, you don't need it for 20 years. throw it in a 12-year project.
Jeez,
right?
man, I wish I knew about these projects when I was 20 something, and I was,
I'd say.
But at that time the rules were different, because to get involved in a lot of this stuff at that time, especially the projects, you had to be accredited, and then they changed it to accredited. And what's the other term again?
Accredited and eligible.
Eligible,
Accredited,
right.
eligible, and even non-eligible can still invest. It's just they're capped in how much they.
Oh, is that what it is? Yeah, but in the past, wasn't it always?
I think it was prior to 2016. It was largely only to the high net worth individuals, institutional level investors, right? Then in 2016 here in Ontario specifically, the rules changed to allow for more participation from the eligible investors as well.
And then that must have grown the industry, I guess, as well, right? Because just more people could participate.
Mm-hmm. Eligible investors are the bedrock that we've built our business on at Equiton.
And what's eligible? Just so anyone listening, if they're not familiar
criteria,
with it, yeah.
So in terms of criteria, individually, they're either earning an income of $75,000 or more, or a household of $125,000 or more, or they've got a net worth of $400,000 or more. Mm-hmm. As long as they meet one of those buckets.
And net worth, you can take into like a principal residence into that?
Primary residences,
equity, yeah, okay.
financial assets. The easy way to say it is, if you're from the GTA or the Greater Vancouver area and you own real estate, you're an eligible investor.
Yes, pretty much. Right? For a period of time, unless you bought it like in February.
Yeah, unless you bought it last year and your loan to value is 80%.
Yeah. I lose track of time. I don't know. COVID threw my
almost into 2024, right? So
yeah, I know. I see the hairline. My daughter reminds me every day that I'm getting old. So yeah. Cool. So then what is the latest thing? Like, is there anything different you guys are seeing right now? Or is it just the same? And I don't mean this in a boring way. Mm-hmm. Like, I think real estate, to kind of your point earlier, is boring. And I think that's a feature, right?
Yeah. And if it's not, you're probably not doing it right. You're probably not looking at it the right way. You probably have the wrong guru or coach. Honestly, if you're looking for excitement from real estate, it's not right.
I remember this world that was this development world, and there was there's been a lot of people that have come and gone in this world.
Yeah, sure.
And we had some people in this world, and they have multiple actually, but two actually stick out, and they came in and they were telling us, about all the projects, and here's, if you invest, here's the return, and it all sounds great. And I'm like, well, I don't get it. Like, what about this? What's the downside? They're like, no, there's no downside. It's all guaranteed. Like, it's all. And I'm like, man, as soon as someone in real estate starts telling me that like my return is guaranteed, and like there's no everything's going to be okay, there's no possibility of any downside, I'm like, I run for the hills. Yeah. So we ran from the hills from those guys, and that worked out well because they didn't. They've got into a bunch of legal trouble. And then there was another one, same thing. They're like, it was a bit of a smaller firm, but we said, well, what if the market turns and the prices change? They're like, we're going to make everyone whole. Like, well, how the hell are you going to make everyone whole? You don't even know the number. Like, how's that? Like, how can you even say that?
You're going to make everyone whole until you file for bankruptcy.
Yeah, which was about a year.
Recourse.
Yeah, and it was about a year later that they were gone.
Of course.
And I was like, well, so
of course.
Yeah, we've typically run from this type of stuff. But to be fair, we've kind of worked with you guys for a while over time, and you guys know we're super hesitant with this stuff. We're like, who are these guys? Yeah. What are they doing? What But you cornered me at the gym and said, hey, I got to talk to you. So.
Yeah, I don't typically like to bug people at the gym. You know me, I go in heads down, go do my thing, get out.
And you know me, I'm usually there with a hood up.
Exactly.
If you see me in the morning, when you used to see me in the morning.
You're always in the morning.
I was like, I don't talk to anyone. I'm like, they're like, who is this guy in the corner just doing his thing?
I was telling Lawrence, I was a little hesitant to even approach you. So, I don't like to bug people at the gym. This is their own time,
That's fine. That worked out.
I said, are you kidding? Yeah. I'm like, go get them.
Yeah. So what's then what are you guys seeing for your own stuff? Like with how are you setting stuff up now so you have a son coming?
I do.
Right. Do you have kids, Cosme?
No, I don't.
Okay. So then we're going to pick on him.
Sure.
Let's do it.
Okay. We're going to pick on Lawrence.
Okay.
All right. So for your investments for your family and your son now coming down the pipe, knowing what you know, knowing what you've been through, knowing what your paisanos have been through, when they came here, like, how do you communicate what's left and what the upside is? Because we have obviously the concern with people now is they're like, well, look where prices are, look where affordability is. There's like, there's challenges there. Like we can't, yes, maybe interest rates go back down to zero. Maybe they don't. So affordability gets a little bit better, but maybe not so good. How do you navigate this world for your family right now? And I'm not even just talking with with Equiton products and stuff. Like, just what's your personal thinking around this type of stuff and affordability in real estate? Like, are we hitting up against this stuff? Is that still a viable option for your family?
I think about it all the time. honestly. Even before I knew I was going to have a son, I think about it all the time. I'll speak about the real estate environment, but honestly, this blows out just more generally. The real estate market over the past decade has gotten really speculative, really hairy, right? Out of line with fundamentals. We can say that for certain. Yeah. What I'm seeing in the market, and this is how Equiton's conducting themselves, this is also how I'm conducting myself personally, it's more of a retrenchment back to fundamentals. And when I'm talking about fundamentals in real estate, 2 words, cash flow. That's what I'm looking for. And personally, there's lots of ways I can attain that cash flow, right? And we're blessed actually in some ways to have high interest rates where they are, because I can put my money in a money market fund and get 4.8 to maybe 5.2% interest.
Yeah, which seems crazy because over the last decade, you look at banking, you look at those products as interest rates, they don't even compute as something to even consider, right?
Well, it never existed. Like our generation of investors, we're in our mid to late 30s, we'll say, but we never knew interest rates. Risk-free return didn't exist, right? You had to speculate, right? That's what was done. And now there's been a paradigm shift back to more fundamentals just because you have to, right? The days of 20% capital appreciation on a single family bungalow is gone. So when you don't have that level of appreciation, what are you left with? You're left with carrying costs. I need cash flow, right? And so that's how I've been structuring my portfolio.
And then you're looking at it for cash flow for that's your return, or you're looking at it as cash flow to own the asset with the return that you're actually after is the self-liquidation of the asset. Or the potential of further appreciation over like the long term, like not 20%. If we go back to historic norms of about 7%, which seems I was surprised that it is 7%, but around here it's about 7% year over year.
Mm-hmm. I think, look, every investor is different. I'll speak for me personally because you asked me, and I'm sitting in the chair. I'm looking for cash flow, positive cash flow. That cash flow is not just a carrying cost. It's not a means to an end so that I can hope and pray that this investment's going to double in value on the capital appreciation side. The income that the business generates, and when you buy a property, you better believe it is a business, that is your profit. Just ask Warren Buffett. When he deploys capital in an insurance company or Coca-Cola or Apple, he's doing it because of the free cash flow. And he is probably the most successful investor to have ever lived. Yeah. Right? And I've modeled my perspective on that same thing. I'm never, ever, ever buying a negative cash flow building. Never. I will never, ever do it. And I need the cash flow because it gives me peace of mind, but it also helps with the carrying costs and all of that other stuff, right? You don't want to be in a negative carry situation. Bringing it back to Equiton, why do you think we buy properties in Edmonton instead of Calgary, right? Cap rates are higher. It's a better cash flowing investment, right? Why do you think people invest in the residential fund? It's that routine cash flow that people have come to expect, right? It's funding their retirements, right? So it's a retracement back to these fundamentals that I've done for myself. I think a lot of investors are doing. It's just more defensive. It's more comfortable.
But if you can, so back to that point, the fund aims the apartment funds. You aim for almost 6%, high fives, something like that. So I know it's not guaranteed, but I mean, what's the aim?
The fund targets total returns on average 10%.
That's total returns because of...
That's a combination of the capital appreciation, but also the cash flow.
Okay, so let's just go back to the cash flow component, because I think that's going to be the answer to my question. Because if the cash flow component was about high fives, if I remember.
Call it 5.8.
Okay. Because if someone can go now and get the GIC for 5%, why because, and where this is coming from is, that you're getting higher yield in Edmonton, but you're taking on higher risk. Generally, with in a normal investment in landscape, the higher yield is associated with higher risk, right? That's normal. So you're taking higher risk there. So you're getting a marginally higher yield on the cash flow component from the fund. But if you can go to, I don't think anything's risk-free. I know it's called risk-free, but if you look at what happens with bonds over the last couple of years, that was considered a risk-free rate of return right now, and they've got slaughtered. But if you can go and say, to the quote unquote risk-free rate of return to the banking at 5%, don't investors look at that sometimes and be like, well, I'm not going to invest in this fund right now. I'm just going to.
Of course they do. And that's why a lot of my capital is parked in a money market fund doing the exact same thing you mentioned, just supposed risk-free. So what's the upside for something like the apartment fund? That's what I was going to say. They got to take that into consideration, right? 2 things. Number one, the average return that we deliver over the last 5 years has been 10.7%. Okay. And that includes last year. Last year we did 14% in a market, by the way, where interest rates were high, real estate assets depreciated, right? So we have a nasty habit of generating very consistent returns year after year, agnostic of what the market's doing. So I know I'm getting that 5.8, but I also know that I'm going to get something slightly more. But let's take the appreciation off the table. Why would I invest in a risky asset at 5.8 when I can get a risk-free asset at 5? That 5.8 I'm getting is marginally higher than the risk-free rate I'm getting. The 0.8, is it worth it? It may or may not be to you, depends, it's a personal question. But what I know is worth it is the incremental upside on that cash flow. Because today it's paying 5.84. In a year and a half, it's going to be paying 6.04. In 4 years, it's going to be paying 6.9. In 7 years, it's going to be paying 7.8. Because insofar as we can increase the profitability of our buildings, which we do through active management, I can increase that distribution amount to clients.
But couldn't someone then wait and get into it at that time? And the reason I'm asking this is you were saying when you look at the investment, you're looking at just the cash flow, which is fair. But no. If you're just looking at just the return, really what you're looking, what you're explaining now is like, yeah, well, I'm looking at the cash flow, but it's this higher rate of return, which I'm really considering longer term. I know you're talking in the current example just about the cash flow number potentially increasing, but I'm talking about the 10 point something or the 14% last year, whatever. That was really a combination of the cash flow and some sort of equity build or appreciation. So that's what people are making the decision off of. So you kind of got to take that into fact.
I see your question, but you can't really just wait on the sidelines to get that higher yield, right? So you're saying, well, why don't I just make a risk-free investment today, and then in 4 years, when the apartment fund starts yielding 7%, I'll just invest that.
Sure, yeah.
But you can't do that because the yield doesn't really fluctuate that much. And the reason why is because as the distribution goes up, the unit price of the fund is going to go up. So you're always going to get approximately around 5.8%. It could go up to 6, it could go down to 5.5. But anytime you buy in, you're going to be sort of within that window. Right?
So if you buy in at a lower price, then
but if you buy in at the price, you're locking in that cost basis. That's the technical term. So when the distributions increase, your yield actually goes up.
Got it.
Right?
Got it. Okay. Let you off. No. I was just trying to understand because that's the way I look at it. I think you've got to combine everything. Like the cash flow component is essential for. Like you said, it's a business. And if you buy a business with negative cash flow, then the goal of buying that business should be to turn it around to create positive cash flow, therefore increasing the value of the business. Mm-hmm. So you're getting then the cash flow component from an operating standpoint, but then you're also at the same time generating equity. And I just feel like if you go back to the Warren Buffett approach, I just look at the long-term, any real person that's had long-term success in investing in any industry, very few people that has it been just from just the income matters, but it's the creation of the equity in whatever asset class they're in. Then they're able to leverage that equity to then grow that asset base and create more equity. Mm-hmm. And then it's that equity over time really that grows for people. And that's why me personally, and that's why I'm asking, just trying to get an understanding of what you're thinking, because I look at the creation of that equity that I can leverage or not leverage, but the ownership of a percentage of assets underneath me in my financial picture and for my family, that changes our lives because then I can always fall back on these assets. I'm not just dependent on whatever's going on in my current bank account or, one stream of income or whatever the case may be. Mm-hmm. Right. So that's just kind of the way I look at it. Right.
Yeah. I think I look at it the same way, but I see that long-term capital appreciation or that long-term equity accumulation in an asset. I see that as a secondary or even tertiary benefit. Mm-hmm. It's going to happen in the background. I know it's going to happen. Why? Because I'm paying down my mortgage, and I know that asset classes generally will appreciate over time. Maybe not year by year, but decade by decade, you better believe it. So that's going to happen passively in the background. I know that. I don't need to worry about that. Right now, I need to worry about my cash flow, right? And then that'll take care of itself. The left hand will wash the right on that side. It's always going to be there. Yeah,
so we are. That's exactly how I look at it too. I wouldn't, and I think because lately, and I'm sure you guys have seen the same thing, many people get caught up in just the cash flow becomes, or the income becomes secondary completely because they're just like, well, the price of this thing's going to go up. Whereas you can't bank on that. So you need to invest for the income and then knowing that over time that's going to create the other things,
Yes.
you know, along.
Well, you used to be able to invest like that and to great success, right? A lot of people have built empires, small empires based on that exact strategy. But what we're seeing now is a complete paradigm shift. And I think that's my point. It's this retracement to cash flow, as I said earlier. You need to start thinking about your real estate assets a bit differently because what got you to this point in your portfolio, into your professional investing career, isn't going to take you to the next step. Yeah. It'll actually burn you.
Let me ask you something about I mentioned it earlier, the long-term historic average. This is the residential real estate price on the Toronto Real Estate Board. It's a 7% annual appreciation. That's when you compound that out, it's high, right? It's strong. And I know that's, you know, there's ups and downs during that period, but that's kind of ridiculous in some ways. Do you think that's feasible, that real estate can continue to appreciate call it over a 10-year period, right? Can we still hit, even if it's not 7%, do you think it can hit 5% a year? Like that ends up being another 50% increase, which when we look forward today, it seems kind of nutty.
Yeah. I don't know. That's a tough question to answer.
I have my answer.
Yeah. What's your answer?
In a word, no, it's not possible. And the reason is simple. Housing affordability is a factor of two different market forces. Number one is asset prices. Number two is incomes. So asset prices can appreciate at 7% historically, as they have, and that'll continue to compound. But insofar as household incomes aren't appreciating at something along those lines, doesn't have to be 7, even if it's 5, fine. But insofar as those two aren't aligned, houses will continue to get unaffordable. Eventually that growth will stop, right? You can only take on so much more debt.
Yeah.
Right?
I agree with you. That where I get confused is that if I look back 10 years ago and I told you where the numbers are today, and I'm talking about myself, I wouldn't have believed it. Yeah. I'd be like, it's hard for us to visualize. So to the point about compounding that we were talking about earlier, when we look at those numbers, it doesn't make any sense, right? We bought one of the student properties that we bought now probably 20 years ago. We bought it for $230,000. It's probably worth, it's come down, so it's probably worth $750,000, $800,000, something like that. When we bought it, the guy that we bought it from, I want to say it was like 40-something thousand when he bought it, or 30-something thousand, and he had just an interest-only mortgage on it for years, for decades. That's all he did. And we laughed about how much it must have been about 40, because we laughed that it went up about 5 times, and we bought it for roughly 200,000. So it must have been 40 and change. Wow. And then we looked at the price that we bought it for, and Tom's like, "This is going to be $1 million student rental," and we laughed. We're like, "Yeah, $1 million. Can you imagine $1 million? Like this property by McMaster's going to be $1 million? Yeah, okay." But it's been 20 years, and we look at it and we're like, holy shit, like this thing's actually approaching
$1 million.
Yeah. And it's ridiculous. And I know we've seen this interest rate, like this period where interest rates have dropped and things like that, but do people care anymore, like how much the price is, or do they only care about the payment? And the reason I'm asking this is because if we look at the debt numbers, I have a great chart that I should have showed you. We mapped out the Canadian M2 amount against the average Toronto Real Estate Board price. And if you see this graph, it like mirrors, they mirror each other. Not exactly, but the trend of as M2 growth increases, the prices increase. It's like you just look at it and it just becomes mind-boggling. And we're like, if we're in a world where they're going to inflate more things away and continue to print, then do asset prices continue to get the benefit of that?
It's tough to say. Honestly, it is, because I agree with your logic. Like everything you've laid out to me is accurate. But
I'm not even saying that they're going to. I'm questioning. Like I'm trying to figure out myself, and that's why I'm asking you guys, because you're in it. So sorry. Go ahead.
Theoretically, I agree with you, but there's going to be a point of terminal velocity where those two things can no longer stay aligned with one another. And I think we're approaching that point. And you made an interesting comment earlier. You said that people are willing to pay any valuation because they don't use that as their barometer. They're using the carrying cost, their payment.
Yeah.
Right? Now, that payment is inflating because of interest rates, right? So that has to affect the asset prices.
For sure.
Right? And so we're going to see a natural correction. And like, I'm not going to sit here and call for doom and gloom. I've built my career on real estate. I believe in it vehemently. But do I think it's going to grow at an CAGR, a compound annual growth rate of 7% for the next 25 years? That remains to be seen for me.
Yeah.
Right?
Yeah, and I'm not talking short term. Yeah, I don't even look at like, I'm always like 5-10 year horizons, and that's what because the way I wonder, I'm like, did they come and change the mortgage rules here, which gives it again then more legs afterwards, right? Because so like we've had a correction, we've needed it, and I hope that things don't appreciate the same. Like, I own real estate, and I'm hoping they don't appreciate the same way they have. Like
it's not a sustainable market.
Yeah, exactly. But then I'm like, man, but if they mess up this whole economy, then what do they do to try to fix that? And I'm like, I don't see a world where longer amortizations are coming in mortgages, where longer amortizations, are not coming.
You said they. I'm assuming you're talking about our government.
Well, they're the smart ones.
The puppet masters.
Yeah. They got it all figured out. Yeah. So I'm just like, I'm trying to get into the minds of the geniuses.
Oh yeah, the geniuses.
Yeah.
That's a separate podcast, I guess.
Yeah.
There's one saying that I keep going back to in my brain as we're having this discussion.
What, the government doesn't know what the hell they're doing?
No.
Oh, okay.
Show me the motivation, and I'll show you the outcome.
Yeah.
Right. So we're going to come up on an election year next year. The Liberal government is now talking about affordability. It's a hot topic.
Last year they said they don't give a shit. It's not a problem, right?
But they're
all
up
of a sudden housing matters, right?
Yeah.
But does it matter in the way they think it does? Because do you know who votes? Baby boomers. Do you know whose retirement is based on sky high real estate valuations? Baby boomers.
Yeah.
Right? So they're walking a very thin line because yes, it's trendy and hip to have affordable housing. But do you really want to start destroying the wealth of other Canadians as well and alienate the other side? And so they need to be very careful with their verbiage and their legislation, right? Because yes, increasing housing supply, giving bursaries and tax cuts to developers to produce more rental housing, all of this is going to help, but it's going to have maybe unintended consequences for them. And they don't want that.
Yeah, see, and that's what I wonder. I'm like, they want greater affordability, but they don't really want the affordability through price drops. And not just from the baby boomers, because I think it's the banks, because the banks have all these loans out. Yeah. So if they get a big price drop, this is a big problem for them. We can't be in a big deflationary era, because if we go through that, the people that hold the mortgages, the banks are like, it puts them on shaky ground pretty quickly. Yeah. So, and we're under the belief, Tom and I, we're under the belief the banks never lose, right? Because it just always feels that way. So we look at that, and the politician, there's lobbying and all this stuff. So that's what I just try to figure out. And I don't have a crystal ball either, but I'm just, so that's why I'm like, if they can hold things while, they've had some wage appreciation, they can get some wage appreciation if they change some rules. Because I don't see how even in this coming election, there's not something for either first-time home buyers or something. If it's not this election, it's the next one saying, hey guys, I know, things are really not affordable. Here's what we're going to do. Because we care about you so much as a first-time home buyer, we're going to allow you to do whatever, this, or whatever the number is to get into the market. We'll help you this way. We'll extend amortizations. We'll do something else. I don't know what it is, but I'm like, I don't see how that incentive is not coming down the pipeline because they're trying to buy votes. Yeah. I'm not saying it's right. I'm not saying where the market's going. I'm not saying the market's only going up. It goes sideways, down, whatever. I'm just like extrapolating this out long-term. And to your point about the motivation, I'm like, if they're making the rules, the motivation is to get votes. They need to get these votes from somewhere, right?
Yeah. I don't think they want depreciation in asset prices in the real estate space. I don't think they want that because it's going to alienate an entire voting class.
Yeah, not in a big way. There's like little fluctuations there, of course.
4 or 5, 6%. That's not depreciation. I'm talking about a crash.
Yeah.
They don't want a 20% revaluation downward. What I think they want is nominal growth in line with GDP. So anywhere between 2 and 4% for the next 5 to 7 years. And that's the soft landing, we'll call it, right?
Yeah.
So it'll give supply a chance to catch up with demand. It'll give them the opportunity to get a little more wiggle room a few years down the road where they can actually lower interest rates and alleviate carrying costs on Canadians. All the while, everything will just start to sort of level out. That's what I think they're after. That's what I'm of the belief we're going to have. I'm not calling for an impending housing crash. Nothing that I'm seeing leads me to believe they're ever going to allow that. Our economy is too dependent on real estate valuations for the government to allow that to happen. It would be pandemonium here if our real estate assets fell 20%. Could you imagine?
Yeah.
Well, it'd be everywhere. Well, we have, we kind of have, but the peak was such a short.
Well, 20 or 30% from the peak of last year.
Yeah, which was, to me, it was like
which is artificial.
It was, I agree completely.
Yeah.
And it was like a 60-day thing. I'm like, does that really
I mean, from today, right? As we sit here in November.
Yeah.
But I do think we're just going to see a little bit of subdued growth. It's going to grow with inflation or with GDP growth, 2 to 3 to 4% a year. Still going to be decent. But again, if you're not getting that 20% capital appreciation, cash flow becomes more important, right?
Yeah. Yeah, no, 100%. And it's, to me, I've always looked at cash flow as that's your safety net in real estate.
Yeah.
And basically the bigger the cash flow, the thicker the net is beneath you. I look at, if you're walking a high wire act, if you have no cash flow, well, then you basically have little to no safety net. If you have $50, well, you got a tiny little one. If you have $500, whatever, you can extrapolate the numbers out. Obviously, they're bigger on larger properties and projects, right? But the more the cash flow, the better, right? It just kind of, it's your insurance policy. So,
Sure, yeah.
Cool. Anything else you guys want to share? I guess what about who should they read? If people are listening to you guys, are like, hey, I'm kind of interested. I have a Lira, and I've had it for 20 years, and they made more money than me. They made $50, but they're actually looking at a real return or whatever else. The RSP, accredited eligible. If people want to reach out to you guys for some investments, what do they do?
Yeah, we'll leave you with our contact information, but I don't know. Is there a general inbox?
I would say just visit the website and, of course, reach out to the folks at Rockstar for the listeners at home if you guys want more information. I'll do a quick plug for Equiton, but
sure,
really
do the plug.
We have a pretty diverse basket of real estate solutions that we offer clients, centered around passive real estate investing, where you're not a landlord yourself. You don't need a massive down payment. You don't need financing. We've got different strategies for different people. We've got high growth development projects. We've got rather conservative cash flow machine investments, and that would be the residential fund that we were chatting about. If you're curious to learn more about what we do, or even just want to chat about real estate, give us a call, go to our website, reach out, book a meeting with one of us, and we'll just talk real estate. Yep. The reality is our team just loves to talk about real estate. We get paid to talk about real estate all day. It's a pretty awesome thing, just like you.
Do you get sick of it?
No, never.
Do you get sick of it?
No, because I intentionally chose to be in this position, right? I mean, I intentionally chose to be in this industry. I could have done, I guess, anything else, really.
Were you in this industry before you were working with Equiton?
So I was in the private real estate space before Equiton, but just working largely with land development opportunities, right? And then prior to that, I was actually in the corporate world, so yeah.
Corporate world's a big shift. Well, you guys are very, you've dressed down today, actually.
Yeah,
you don't
usually
have a jacket
I got the suit
or anything.
I wore the vest.
I dressed up for you guys. I put on long sleeves instead of a
no
t-shirt.
Flip-flops?
This is no flip-flop.
Oh, nice.
Was I wearing flip-flops last time we met?
I'd like to think you were.
Probably, yeah.
I think it was shorts and flip-flops. It was summertime.
So, I mean, it's hot. You got to wear flip-flops. And when I come back from Europe in the summer,
I think it was just before you went to Europe, actually.
Yeah, to get me out of shorts and flip-flops after just living that life for that period of time, it's a tough transition. I got to be honest. The first time I put socks on, or especially pants, when I have to go put a pair of jeans on because it finally cools down and I'm getting cold.
That's when the vacation's over, when the leg goes through first. Man. You're like,
it's the worst. Yeah, it's the absolute worst. Yeah, I'm not a fan of that. But cool, guys. This was good. We didn't touch on some of the development stuff that you guys are involved in, so we'll have to have you back and we can kind of touch on that stuff a little bit, because I'm curious to see what you're seeing in that space, which is primarily mid-rise. You don't do, because, and I understand why, because of the pain in the butt of getting like larger subdivisions built. You don't really do much in the low-rise space.
They're elongated projects. They're more expensive. The zoning and the approval process is much more complex. And frankly, they're just not as profitable, especially now with the green belt coming back. It's a whole other thing.
Yeah.
So we try and stay away from it.
So last question, those mid-rise projects, I mean, obviously Toronto, there's demand for those. Like, what other areas are you looking at on the development side? Are you guys looking at right now? Is that primarily Ontario based as well?
Yeah, very entirely Ontario based right now. So, and
is it major? Like, is it just like Ontario stuff? Toronto stuff.
Yeah, or? I'd say mainly GTA, but if anything's along that 401 or QEW corridor, might strike us. We'll look at it, but it's really just that GTA
that's really the heart of everything, man. Those two highways going from the biggest city in this country to the biggest economy in the world. Yeah. I've always felt like as real estate investors, we're cursed and blessed, I guess, because blessed in a way that there's so many different areas to invest in that can make good sense versus when you go to, maybe upper New York State, compared to a lot of the fundamentals in this golden horseshoe, greater Toronto, Hamilton area, versus some like, Buffalo or Rochester or something like that. It's a vastly different market, so we get the benefit of that. The downside is it's pushed prices to this point too because of the demand for it, right? So, but okay, cool guys. This was really great. So thanks. So just visit the website. You can reach out to our team. We can share anything with you. Sure. I don't know, no email address or something, or I can add it.
Yeah, we'll put it in the show notes if you're going to put it on YouTube. And honestly, just go to www.equiton.com. You can click on either of our beautiful faces, book a meeting, whatever you guys would like.
Okay.
We're easy.
Awesome. Sure. Thanks, guys.
Thanks for having us. Yeah.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.